Hello and welcome to Forex Academy, your #1 website for Forex and crypto education and analysis.
In today's edition, we're going to be discussing fundamental analysis for novices, the Chicago Fed National Activity Index. If you are new to trading, one of the most important aspects of a daily trading routine is to analyze economic data and releases from the governments around the world. These reflect the health of that particular nation's economy. This data can be found on an economic calendar such as this one. Most brokers provide an economic calendar, so you should refer to it every day in order to avoid trading around times of possible extra market volatility surrounding the release of high-impact economic data. The most important aspects of the economic calendar are the time and date of the event, the impact value, which is typically low, medium, and high, and where high-impact news is even more likely to cause extra volatility upon its release. The actual data which is updated in the calendar at the time of the release and which is usually subject to an embargo. The consensus where available, which is the anticipated actual release as put together by economists and analysts, and also the previous data which is usually released weekly, monthly, quarterly, or annually. As we can see, the Chicago Fed National Activity Index for May will be released at 1:30 BST on Monday, June the 22nd, and the impact level is medium, and where there is no consensus value, but the previous value of April was 16.74. Some brokers' economic calendars will provide a brief description of the event, and here we can see that the Chicago Fed National Activity Index, also referred to as the CFNAI on some calendars, is released by the Federal Reserve Bank of Chicago. It is a monthly index designed to gauge overall economic activity and related inflammatory pressure. In fact, the CFNAI is actually a combination of 85 indicators covering areas such as housing, personal consumption, employment, unemployment, hours worked, income, production, factory orders, and inventories. The index measures various aspects of overall macroeconomic activity and was designed by Harvard University. The idea being that the data can be brought together in one single point in order that policymakers can have a more focused aspect for being able to forecast inflation with the US economy. The index has an average value of 0 and a standard deviation of 1. Traders will be looking for a positive reading which will be considered as bullish and showing that the economy is improving. But if the value is negative, it implies that the US economy is contracting or in recession and therefore seen as bearish. Here we can see that from as early as the 1970s, the index has been fairly tightly confined to its zero axis. However, for the year 2020, we can see a huge spike lower to the current levels of minus 16.74 for April. Of course, this can be associated with the coronavirus pandemic and the terrible impact it is having on the United States economy. Traders already realize that the economy is in a bad state and that the figure is going to be well below the zero axis. There will also be no shocks or surprises that the figure is going to be bad. They will be looking for how greatly the number will be with regard to its divergence from the release of May. Therefore, a less or minus figure will show that the economy may be bouncing back and may have hit the bottom with regard to the impact of the coronavirus pandemic, and this will be seen as positive or bullish for the economy, and where you could find potentially an improvement in the exchange rate for the United States dollar and also an uptick in the stocks and indices. However, should the minus figure be even greater in value to the previous release, this will show that the worst is not over yet for the US economy, and we might find that the US dollar loses value against its counterparts and stocks and indices may fall as a result. The higher the divergence from the previous month's figure in either direction, the greater the risk of market volatility.
If you enjoyed the video, then please like and subscribe and leave a comment down below about anything you would like us to discuss in future, or if you have any questions about this particular video. Have a great day.